Look at your savings account. You might think that money is just sitting there, safe and waiting, but it is actually quietly dissolving. This chart shows how the math is failing you. While your bank offers a 0.1% interest rate, inflation pulls your purchasing power down by 4% or more, meaning your safe savings are actually shrinking. Today, we are building the three-bucket velocity system, a methodical approach to organizing your liquid capital for both safety and growth. Open your banking app, check your current balances, grab a calculator and a notepad. Moving to a multi-year wealth defense system begins by confronting your current bank balance and identifying exactly how much of your cash is currently losing value. This is the three-bucket architecture. We begin with bucket 1, your liquidity. This account serves one specific purpose: short-term survival. Write down your core baseline monthly expenses, your rent, food, and utilities. Multiply that exact number by 3 to find your target total. This specific account must hold exactly 3 months of expenses. Once you reach that number, the bucket is full. Any cash sitting in this primary account above that calculated target is actively losing purchasing power to inflation. The 3 months of expenses in bucket 1 provide the psychological safety needed to execute the more aggressive parts of the strategy. Once bucket 1 is capped, we move to bucket 2, the protection layer. This acts as a high-yield fortress for your excess capital. Open a new tab and locate a high-yield cash management account. To function as your protection layer, it must have the 3 mandatory features on this checklist. It needs to be tax-advantaged, offer compound interest, and provide liquid access. There are advanced options for this bucket, such as specific whole life or infinite banking structures. I've linked resources in the description for those who want to research those further. However, do not delay transferring your cash because you are researching complex insurance. You should start with a basic high-yield account today to ensure your money begins compounding immediately. Bucket 2 is strictly for safe, steady yield. You must never expose this specific capital to volatile stock market plays. Organizing your money this way ensures your liquid excess remains in a high-yield environment, rather than a standard savings account. That brings us to bucket 3, the growth layer. This is where you eventually deploy capital into assets like real estate, index funds, or your own business. This chart outlines the yield rule. You only move money from bucket 2 into bucket 3 if the projected return of the new asset is higher than the safe yield you are already earning in your protection account. If the asset's yield is lower, the transfer is rejected. Following this flowchart prevents you from investing emergency funds or liquidating assets at a loss when the market dips. Now that the logic is clear, we will execute the total allocation audit. Look at your total liquid cash. Subtract the exact number we locked in bucket 1. Any remaining amount is your excess. Log into your bank immediately and schedule a transfer routing that entire excess balance into your new bucket 2. Adhering to these mathematical triggers ensures every dollar has a specific assignment, whether for survival, defense, or growth, and prevents your capital from sitting idle. By completing these steps, you have established a survival floor and moved your surplus funds into a more resilient, yield-generating account. This shift moves you out of a monthly spending loop and into a systematic allocation of your resources. Reflect on where your account stood before this audit. Let me know in the comments which of the 3 buckets was completely empty for you before watching this. Use the setup links in the description to finalize your bucket 2 and subscribe for the next breakdown of wealth management systems. Wealth protection is not about quick wins, but the result of disciplined capital allocation across multi-year horizons. Continue auditing your buckets, and I'll see you in the next one.